Consequently, the trade deficit remained high in July and August. Services exports continued to grow at a robust pace amidst resilient demand for software and business services and modest recovery in travel services. On a balance of payment basis, that is on a BOP basis for which data were released yesterday, exports of services grew at a robust pace of 35.4% year-on-year during April-June this year. For the same period, remittances rose by 22.6%. The net surplus on exports of services is expected to partly offset the higher trade deficit. So as you can see, both services sectors have grown at a robust pace of 35.4% and remittances have grown by 22.6%, and that is why I am making the statement that the net surplus on exports of services is expected to partly offset the higher trade deficit. From the external financing side, net foreign direct investment, that is FDI, improved to 18.9 billion in April-July this year from 13.1 billion a year ago. Foreign portfolio investors, that is FPIs, have returned to the domestic market with a net inflow of $7.5 billion during July to September after an outflow for 9 consecutive months. India's foreign exchange reserves now stand at $537.5 billion as on September 23rd, and this compares favorably with most peer economies. And this is important, about 67% of the decline in reserves during the current financial year is due to valuation changes arising from an appreciating US dollar and higher rates of higher US bond yields. Incidentally, there was an accretion of $4.6 billion to the foreign exchange reserves on BOP basis during the first quarter of the current financial year. So it may be seen that our market interventions continue to be judicious. India's other external sector indicators, namely the external debt to GDP ratio,